Hello viewers, welcome to my channel. I'm Hasham. Now I'm going to start chapter number 3 in financial management for BBA. First chapter I have explained the introduction to financial management, where I have explained about the meaning, definition, scope, objectives, completely theory I have explained in chapter number 1. Chapter number 2, concept of time value of money. One video I have completely explained the theory, and next 3 videos I have completed all the problems, nearly 26 problems I have explained on the time value of money. Now third chapter, this chapter is very important because in examination problem is compulsory. Normally every time problem will be asked from this chapter called capital budgeting. Now in this video I am going to explain the complete meaning of the term capital budgeting, what are the techniques of capital budgeting, what are the characteristic nature of capital budgeting decisions. First of all, every business will incur expenditure in 2 ways, revenue expenditure and capital expenditure. Revenue expenditure is the day-to-day expenditure. The expenditure which is paid every period, like monthly it is paid or daily it is paid, like payment for purchasing the goods, payment of rent, electricity bill, salaries, wages, all these are the day-to-day expenses. It is called revenue expenditure. Another type of expenditure is capital expenditure. The expenditure which is incurred in acquiring fixed assets, or the expenditure incurred in setting up a new plant, new branch, or a new product we are going to make. So any expenditure which will give you long-term benefit to the business, that type of expenditure is called capital expenditure. Now this capital budgeting, this is a technique which is applied to evaluate whether it is prudent or not to invest the money in capital expenditure. That means in capital project. So different definitions are there. Simple words I can say. Capital budgeting is a technique which is applied to evaluate whether investment should be made in long-term project or not. So before making the investment, we have to evaluate. The business has to evaluate whether it is prudent or not, whether it is profitable or not to invest such huge, substantial amount in that project. So this chapter will explain you what are the techniques available to the finance manager to take capital budgeting decisions. First we'll see the meaning. Different authors have given different definitions to the term capital budgeting. Now capital budgeting constitutes the strategic process of evaluating and determining investment in capital expenditure. Why it is called strategic? Because the decision will be taken by the top management. Because many reasons are there. The first reason is it is critical, strategic, important because amount involved is huge. Secondly, the implication of this decision will be prolonged in implication. Right now we are taking the decision, but it will affect our business in a long period of time. That's why it is called strategic process of evaluating before making the investment. This type of decision is called capital budgeting. Secondly, such expenditure are also known as long-term investment decisions. Capital budgeting decisions are also known as long-term investment decisions because we are going to invest in a long-term project. Intent outlines whose benefits are anticipated over a period of extending beyond 1 year. Right now we are taking the decision, but we are going to get the benefit in a future period of time more than 1 year. Next, capital budgeting decisions are crucial for business as they determine the allocation of funds towards project. These are very crucial decision, strategic decision, because the funds are invested towards project that are expected to yield return over an extended period. Simple example, in our day-to-day personal life, we will make some expenditure. Like day-to-day expenditure like purchasing the vegetables, purchasing groceries, all these are routine expenditure. We won't think much. But in the same way, if we want to purchase a car, if you want to purchase an AC, then we will think about it. So before purchasing those goods, first of all, we will evaluate which type of car, what is our budget, and which car we want to purchase. We compare it, we analyze it. By thinking in so many ways, we take the decision to purchase the car for personal use. We are not taking instant decision how we take the decision regarding vegetables or groceries, because the amount involved is huge and the implication will be in the long term. Same is the case for business also. A business will also make capital expenditure in making investment in projects which will give benefit for long period of time. That's why we have to take the decision very seriously. By evaluating from every angle, we have to take the decision. Next is capital budgeting is long-term planning for making financial proposal capital outlays. It's the long-term planning decision. Thirdly, capital budgeting is the process of planning and controlling investment in fixed assets to achieve the company's financial goals. So different authors have given different definitions to the term capital budgeting. In simple words, you can say it's a decision which involves capital expenditure in long-term projects which gives benefit to the business over a long period of time. So it is clear from the above decision, it is clear that capital budgeting is the planning of available financial resources. What are the financial resources we are available right now? And we have to make the plan regarding their long-term investment with a view to maximize profitability of the firm. Ultimately, our objective is to get more returns from that investment. We want to increase the profitability or return to the business by making long-term investment. That is called capital budgeting. Now, what are the characteristics of these capital budgeting decisions? Two types of decisions are there: tactical decisions and strategic decisions. Tactical decisions are day-to-day decisions which lower level management can take. Not much evaluation, thinking is required, because in a routine manner we can take tactical decision. But regarding strategic decision, very carefully we have to make. And this capital budgeting is a strategic decision. So what are the characteristics? First, exchange of current funds with future benefits. Normally when we make investment in our routine tactical way, immediately we'll get the benefit. The benefit will not be prolonged. For example, if you go to purchase the vegetables, if you go to purchase the groceries, immediately you are making the payment and you are getting the goods. Exchange is immediate. Whereas in case of capital budgeting decisions, you are making the investment now, but you are going to get the benefit in future. Generation of long-term benefits. Expenditure is incurred now, but benefits we are going to get not in 1 year, but in many years you are going to get. Magnitude of investment. Normally the amount involved is very significant. Huge amount is involved in capital budgeting decisions, right? The amount is more huge. Impact on future profitability. The future of the business will get affected on account of this type of decisions, capital budgeting decisions. If you make a wrong capital budgeting decision, definitely you have to suffer. Your business is going to suffer for a long period of time. That means the future depends on this type of decisions. Investment in non-flexible assets. Once the amount is invested in a particular asset, you cannot change it. That's why it is called non-flexible assets are purchased. Irreversibility, meaning once a decision is taken, it cannot be easily reversed. That means it cannot be changed. If we change the asset, it will incur a huge loss. For example, if you want to purchase a car, without analysis, without thinking, directly you go in haste. In haste you have purchased the car. After using the car for 1 or 2 months, you think that it is not better to purchase this car. We have taken a wrong decision. Now let us reverse our decision. We'll sell the car and get back our money. Can we get the full amount? No. We have to incur the loss. Nearly suppose the cost of the car is, let it be 50 lakh. If you sell it away in second hand market, it will fetch only 30 lakh. That means 2 lakh rupees loss you are bearing because you have taken a wrong decision. So these type of decisions are irreversible. Once taken, it cannot be reversed. Consideration of uncertainty and risk. Because in capital budgeting decision, cash outflow is right now, but your benefit is you are going to get in future, and future is completely uncertain. A risk is involved in future. So in taking capital budgeting decisions, the risk should be considered. How to consider the risk? While doing the problem, I'll explain. So these are the characteristic features of capital budgeting decisions. Now, types of investment projects. Normally, which type of projects we are making this capital budgeting decisions? First one, expansion and diversification of projects. Right now, we are having a company. We want to expand our company by starting another branch, by taking up another project, or by making a new product, or by entering into a new market, or diversifying our activities. All these require capital budgeting decision. Next one is replacement project. Normally, now and then, a business is confronted with a problem of outdated machinery. The machinery has become old. Now we want to replace it by a new machine. Again, it's a problem of investment project, and we require capital budgeting decision. R&D, research and development. Nowadays, almost every business will focus on research and development because innovations have to be made in the products. If we sell the same product, our business will not run long. In order to survive, we have to make the innovations. We have to make changes in the products, in the services. So a lot of money is required in the project of R&D. Last one, new project. A new project we want to undertake. Then again, capital budgeting decisions are required. So these are the cases where we apply capital budgeting decisions. So far, I have explained about the meaning and characteristics. Now I am going to come to the main point, that is techniques of evaluating capital budgeting proposals. Whenever capital budgeting proposal is there, we have to evaluate. How to evaluate? Different techniques are there. Broadly, we divide the techniques into two categories called traditional methods and modern methods. The traditional methods are also called undiscounted methods. That means without considering the time value of money. That is called undiscounted method. Those are the traditional methods. And those methods are payback period, PBP method, and ARR, accounting rate of return or average rate of return. This PBP and ARR, these two are the traditional methods. Now modern methods. The modern methods are the discounted methods where time value of money is considered. So which are the discounted methods? NPV, net present value, PI, profitability index, and IRR, internal rate of return. So totally 5 methods I am going to explain. But in reality, many other methods are also there. And remember, these are only the analytical method. But apart from this, a number of other non-financial considerations must also be taken into account while taking a decision. But we are concerned only with financial considerations. We are not concerned with non-financial consideration. Now, on all these 5 techniques, we are going to do the problems. But problems are based on theory. Normally, students will think that I want to pass the examination, so I must know how to solve the problem. No. Without understanding the theory, you should not go to the problem. This theory is just like a foundation. Can you imagine a building without any foundation? No. It will collapse. So before starting the construction of the building, you have to lay the foundation. जितना ज़्यादा foundation strong रहेगा, building उतनी strong रहेगी. So here also, this theory is the foundation. Now, first method is payback period method, PBP. most widely and popularly used method of evaluating capital budgeting proposal. सब में पुराना oldest method, oldest technique of evaluating capital budgeting proposal is PBP. It is more widely used, more popular method. It's very simple method, but it is having some disadvantages also. Now, the PBP is the period which the capital expenditure is recovered. Simple. The PBP is the time period during which our capital expenditure is recovered. So any businessman, first of all, he wants that whatever I am investing, I should get back as early as possible. That is our main contention. Profitability next. But first of all, whatever I am investing, I want get back. So this payback period will give you the time period during which your capital expenditure is going to get back. The PBP is the time required to get back our investment. How much time period we require to get back our investment? Simple example. Suppose if you want to purchase a car for your business purpose and you think that the car will give you a benefit of 50,000 per year. The cost of the car is 2 lakh. If you make investment of 2 lakh rupees, then you are going to get 50,000 rupees return every year. So first year 50, second year 50, third year 50, fourth year 50. Then total 2 lakh. How many years you require to get back over your 2 lakh rupees? 2 years. First year 1 lakh, second year 1 lakh. So this 2 year is called payback period. Time required to get back our investment. So criteria for selection. How to select the project according to PBP. In case of single project, compare the PBP with the standard PBP. If you are having only one project and you want to evaluate whether the project should be undertaken or not. Simple way. Compare the PBP of the project with the standard PBP given by the management. Normally, the management will give a standard PBP. The management will declare that we will not accept any project whose PBP is more than 3 years. More than 3 years. We want to get back our money within 3 years. Now, this is the standard PBP given by the management. Now, we calculate the actual PBP of the project. If the project PBP is more than 3 years, reject. If the project PBP is less than 3 years, accept. So, we are comparing the actual PBP of the project with the standard PBP given by the management. Secondly, in case of mutually exclusive projects. Mutually exclusive project means 2-3 projects you have, out of which you have to select any one. In that case, you calculate the PBP for all the projects, compare it. Whichever project has a lower PBP, that project is preferable, should be selected. Next is calculating PBP. How to find out PBP? Formula is there. If the annual cash inflows are constant, every year cash inflow are constant, simply apply the formula initial investment divided by constant annual cash inflow. You will get the PBP. Simple formula you apply, get the PBP. But the thing is, this formula will be applied only if the cash inflows are constant. But if cash inflows are uneven, not constant, fluctuating, in that case we calculate cumulative cash inflows. Cumulative cash inflows to find out the PBP. That I'll explain while doing the problem. Now, advantages. In examination, you may be asked what are the advantages and disadvantages of PBP. The first advantage, simple and easy. Even a layman can understand. कितना time लगेगा हमको हमारा पैसा वापस आने के लिए? How much time we require to get back our investment? So simple to understand and easy to calculate because formula is there. So that is the first advantage. Second, saves time and cost. Other techniques will take lot of time, lot of effort, lot of knowledge. But this will not take much time. Thirdly, suitable when cash shortage and liquidity problem is there. Normally this PPP is better in those business where it is facing cash shortage problem, liquidity problem. The company wants to have cash as early as possible. Then in that case, PVP. Shorter payback period preferred to protect the obsolescence. Nowadays, due to advancement of technology, everything is becoming outdated. In such an obsolescence period, it is better to get back our money as soon as possible. So that's why PBP is better. But PBP have some disadvantages or limitations. The first is it ignores cash generated after the PBP. Suppose the project life is 10 years. We have calculated the PBP and we got the PBP 4 years. That means in 4 years we will get back our money. But after 4 years, how much we are getting? We are simply ignoring in PBP. Anyway, whenever we evaluate a project, we should consider all the benefits till the end of the project. But here, we are considering only the inflows up to PBP. Beyond PBP, how much we are going to get, we are simply ignoring. That is a disadvantage in PBP. We have to consider. The next, ignores time value of money. The most biggest disadvantage of PBP is it thinks that today money and future money both are same. That means time value of money is not considered. The next one, ignores cost of capital. Whenever we evaluate the project, we must know what is the cost of capital of the company. It is useless to earn, suppose 20% and we are paying the cost on our capital 25%. What is the point of running the business? We are paying the cost 25% and we are earning 20%. That means the project is not good. So whenever we evaluate the project, we must consider what is the cost of capital to the company. But PBP ignores the cost of capital. Next one is no rational basis for determining standard PBP. I told you that we are comparing, when we are having only one project, we compare the project PBP with standard PBP. Then the question will arise, how the management will fix the standard PBP? How rationally the management can be able to fix the standard PBP? That's also a question mark. Then profitability is completely ignored. That is also a main disadvantage of PBP. It will consider only cash inflows up to payback period. And it is not considering what is the profitability of the project. So these are the disadvantages. Next thing is discounted PBP. One new modified PBP is there called discounted PBP. In this discounted PBP, we discount the cash inflows at a certain cost of capital or cutoff rate. The management will say that cost of capital is 15%, so cutoff rate 15%. So now we discount the future cash inflows at the cutoff rate of 15%. And then we calculate PBP. So discounted cash inflows if we take and calculate PBP, it is called discounted PBP. In that case, time value of money is considered. That means normal PBP, time value of money is not considered. Discounted PBP, we consider the time value of money by discounting the future cash inflows. One method completed. The second method is accounting rate of return or average rate of return. Simply it is called ARR. This method is an improvement over the payback period method as it takes into account the total earning of the project. One of the drawback in PBP is it will consider only up to PBP. But in case of ARR, it consider all the profits till the end of the project life. Then it consider accounting profit rather than cash flow. PBP will consider cash flow, whereas ARR will consider accounting profit. There is a lot of difference between cash flow and accounting profit. Under this method, the projects are ranked on the basis of rate of return. So projects, when number of projects are there, mutually exclusive projects are there, we rank them according to ARR. Whichever project has highest ARR, rank 1, like that. Now, criteria for selection of projects. How to select the project according to ARR. In case of single project, calculated ARR is greater than cutoff rate, accept. The cutoff rate is the cost of capital, weighted average cost of capital. The company's cost of capital is 15%. Now we calculate ARR of the project. If the ARR of the project is more than 15% cutoff rate, we accept the project. If the calculated ARR is less than the cutoff rate, we reject the project. So compare the calculated ARR with the cost of capital. In this way we take the decision. In case of mutually exclusive projects, if we have 2 or more than 2 projects, we calculate ARR. Whichever project has more ARR, that project is accepted. Now, formula for ARR. The formula for ARR is average net profit divided by average investment into 100. Just like how to calculate PBP, the same way ARR. Average profit by average investment into 100. Average net profit is equal to total profit divided by number of years. And average investment is equal to cost of the project minus scrap divided by 2. If any scrap value is there, first we have to deduct to calculate the average, then add up the scrap, add up the working capital. We will get average investment. Then average investment on original investment. Sometimes in the problem, it will be asking original investment. So denominator instead of average investment, we take initial investment into 100. These are the formulas. Now advantage and disadvantage. Two advantages, simple and easy, not so difficult, not much calculations are required. Easily we can calculate ARR. Secondly, profitability is considered. PVP profitability is not considered. But disadvantage, ignores time value of money. PBP ignores time value of money. ARR also ignores time value of money. Next, accounting profit is taken rather than cash flow. If you compare the future benefits, there are two methods, cash flow or accounting profit. Accounting profit will be taken in case of ARR and cash flow is taken in case of PBP. But if you compare both these accounting profit and cash flow is superior. Because in calculating accounting profit, so many judgments, so many assumptions are made. Those assumptions we ignore. Only cash transactions will be taken, how much inflow, how much outflow. That is called cash flow. So cash flow is having a superiority over accounting profit. So here it takes only accounting profit, that's why it's a drawback. This is the end of this session. In this video, I have explained about the meaning of the term capital budgeting, characteristics of capital budgeting, what are the techniques of capital budgeting. The remaining three techniques, that is NPV, IRR and PI, I will explain in the next video. Then we'll start the problem. If you are satisfied, give a like to the video, share my channel and subscribe if you have not yet subscribed. Inshallah, we'll continue in the next video.